Hi, I'm Tom Lydon with ETF Trends here in Chicago at the Morningstar Investment Conference with Ben Johnson, Director of Global ETF Research at Morningstar. Great to see you, Ben.
Thanks for having me back, Tom. I'm glad to be here.
Well, thanks for having us. Awesome conference as always. We're having fun. We're talking to a lot of advisors. What are you seeing from your perspective as some of the major trends in the ETF space?
I think the themes that we're seeing today are the themes that we've been seeing for years now, which is people moving towards keeping things simple, keeping things cheap. We've seen fee wars continue to edge ever closer to zero. Big fee cuts recently from iShares, a recasting of a lot of SPDR ETFs into their portfolio series, which are uniformly low cost now. The race to the bottom carries on. And what I would say is that the other key trend that's taking place simultaneously is a movement away from sort of a la carte sales of slices of the pie. My S&P 500 index fund is better than your S&P 500 index fund.
Yeah.
And a pivoting towards selling whole pies. So if you look at the ETF strategist landscape, the ETF managed portfolios landscape, more broadly just ETF model building, what you're seeing is tens of billions of dollars being invested in portfolio solutions that are made using these individual building blocks. So I liken now the ETF business, if you've got the full spread in front of you, is kind of like a Chipotle. I've got the raw ingredients, I've got the rice, I've got the beans, I've got the proteins, I've got the tortilla. I can recombine those ingredients into any number of different dishes that are going to meet the needs of a broad variety of consumers. It's uber simple, it's uber inexpensive, it's part of this broader trend towards simplification and a driving down of expenses that we see across the value chain.
Or you can order the classic burrito in the form of a portfolio that an ETF strategist may have for you.
Absolutely.
Rather than, as advisors, love the ETF space, they've done great from a pure beta standpoint, but there's fears of rising interest rates and what that would do to the fixed income portfolio, especially the Barclays Ag. There's also returning volatility, what that might do. So having somebody on your bench to maybe package that for you, you're saying we're going to see more money flowing into those packaged portfolios?
More money flowing into packaged portfolios, and let's not forget that the ETF's toolkit since the last bear market has expanded immensely. So you see a lot of people out there saying, well, this whole trend towards indexing is going to get turned topsy-turvy the next time we see a bear market. But subsequently, what we've seen is a host of ETFs that mimic the strategies that have been employed by many active managers for years, low volatility being a case in point, that could potentially take some of the sting out of the next downdraft in the market. So the menu's expanded, investors are stating their preferences for the simpler, the cheaper solutions. They're using some of these more exotic exposures around the edges. The toolkit's great. The fact that fees have come down is great. The fact that I can buy a ready-made portfolio and pay next to nothing for it is great.
Yeah, absolutely. Well, choice keeps getting better. Great seeing you. Looking forward to seeing you in Montreal in a couple of weeks.
Looking forward to it. I'm practicing up on my French. I hope you are too.
Oui.
Oui.